All right, Mr. Mat Cashman, I believe we're live. It's been a few months since I had a technology issue, so I'm always uncomfortable feeling like we're good. But I think
should we knock on some wood somewhere around here?
We got it. We're here.
Okay, good.
We're here now. You and I have done many podcasts, webinars, not podcasts, webinars, and I'm grateful for you always taking the time to come and talk to the SpotGamma audience. I always learn something myself, so thank you. And for people who are unfamiliar with you, why don't you tell the folks who you are before we launch in?
Yeah. Thank you for having me again. It's always a pleasure to be here. My name is Mat Cashman. I'm the Principal of Investor Education at OCC. Previous to this role, I was an options trader for about 25 years and always traded options, vol, relative value, things of that nature, both in the United States and in Europe. And about 5 years ago or so, I kind of hung up the trading spurs and turned in my badge and my gun, and I used all of those, all of that information that I gained over the 25 years previous to teach people how options work. So that's what I do for OCC and OIC now.
Nice. That's a very nice introduction. It's better than if I gave it. But we have Mat. I think this is maybe our fourth episode here, and what I like to do is I like to skirt the compliance line where I try to make you say something you're not supposed to say. Is my
always fun
goal. I think there's a Polygon market on this actually.
God, I hope so.
What we're really going to do today is there's two things. I'm going to start off talking about Michael Burry's puts, and when I said that, you rolled your eyes, which meant that I think I'm on a good topic.
Okay.
And then the second one is NVIDIA, and the reason I want to talk about Michael Burry's puts, or I want to talk about Michael Burry's puts, and I'm dragging you through this, is because I think they're interesting strike selection, and it's an interesting option selection. So we're going to talk about, I'll say some, I don't really quite get it, and then you can maybe walk me through some of the reasons why you may want to buy this. And then the second one is the most important thing that any of us has ever lived through, the NVIDIA earnings on Wednesday night. We're going to look at, that's right, we're going to look at some skews, some vols, some prices, and see what type of trades are interesting. And I do also have the YouTube chat lined up here. So if you have any questions, you want to fire them in. If you put them into YouTube, then I believe I can see them. I think if you put them on the Twitter stream, I may, not see those. So with that, we're going to launch in here.
Yeah.
All right. I also tried to put this in high definition. And,
cool.
And so, it's funny because I was watching Honey, I Shrunk the Kids this weekend with my kids. I was in 1989. And it has this thing in the beginning where it's like super high def, and I'm laughing about it because 1989, that was pretty fancy. Anyway,
yeah,
the 80s seemed like a great time to be alive.
The 80s were a great time to be alive.
Yeah.
How old were you in the 80s, Brent? What year were you born?
I was born in 1980. Yeah.
Were you really?
Yeah, I can claim late millennial, not Gen Z. So
late millennial. Okay, fair enough. Onward and upward, my friend.
Disappointment. All right. So the big story, as everyone knows by now, is Michael Burry bought a whole bunch of NVIDIA and Palantir puts, and this set the Twitter sphere ablaze and created a lot of great media content for everybody. And so for those of you who are not familiar, this is a chart of Palantir, and since late of 2024, it was up 600%. That's a big return, Matt. That's a $20 stock to $180 stock in, I don't know, let's say a year and a half. That's pretty good, right?
Oh, yeah. Last time that I checked, that's a lot of percentage points.
Yep. Now, this is important. This chart is important because the puts that Michael Burry bought essentially would bet that the stock goes all the way back down to 2024 levels, which is interesting. I'm not here to say that's right or wrong. And by the way, on this topic, Matt also has not seen this presentation yet, so we're going to stay in the compliance lane. Nothing here is investment advice. And if he's caught off guard by something, there's nothing really. There's no gotchas in this. This is a shock.
Brent and I agreed before you hit the record button that the safe word was tomato. If I said tomato, he had to stop whatever he was doing and move to the next slide immediately.
Oh gosh. This is a hard delta was maybe.
Yeah, just kidding. Okay, let's see it.
Anyway, all right. So this is the 13F that upset everybody, provoked everybody, I should say. Alex Clark from Palantir got very upset. Anyways, and what it says in here is that he owns these, and we're going to focus on Palantir, even though there's some other positions in here. And it says that it is worth $912 million on 5 million shares of puts, which obviously doesn't make sense. And every single time something like this happens, people like myself scream into the void about how be quiet, stop. This is totally wrong. But those tweets will get like 30 likes. And then the ones that are wrong from certain accounts out there will get thousands of likes, millions of likes. And even CNBC came out and put this up here, and they said that it's $912 million. And this is my little, oh, you can't see my joke. It's hidden. Right.
Oh, there he is.
Oh, now I really screwed it up.
Now it's real small.
All right. I screwed it up. Wait, what? No, I got rid of us. I'm failing miserably.
Oh, you're doing a good job.
Just on everything here. So this is the part that doesn't make a ton of sense. All right. Because this says $9 million. And if you know anything about 13Fs, what you would know is that this is overstated by 100 lot, right? Because they assume every single contract is worth one complete 100 shares of stock, and that's how it's valued. So CNBC puts this up and suggests that we know he owns 50,000 contracts, which would be $18,000 per contract, which is just the math just doesn't work out in any sense. And so I put this little blurb together. Most of the people in this conversation are already going to be aware. There we are of this, but I wanted to make sure it's clear. This is the options education that you came for. The 13Fs assume one contract is equal to 100 shares of stock. I don't really know why they do that. It's probably some weird settlement thing. And so what they write here is 5 million quote unquote shares, which is actually only 50,000 puts. Now, I'm sure everybody that is on our stream here is already aware of this, because if you're into Gamma, you probably already know about this. We also don't know anything about the strike he bought, the expiration, the price that he paid, whether it was a single trade or he hedged it out with a short contract, etc. And this only shows the filings as of quarter end, which was September. And then this is released on November, I think it was 3rd that this came out. So the 13F tells us that at some point he bought some puts, and it really doesn't tell us anything other than that. But the idea of saying that he placed $1 billion bet on something is really sensational, and it gets the people going, even though it's completely wrong. So all this is somewhat relevant for what we're talking about. Now, this is a famous scene from The Big Short. Christian Bale. I was going to ask who plays me in a movie. I think Christian Bale is a pretty good, like if they're going to select. I meant to ask ChatGPT who played me and you, and I forgot. I forgot to do that.
Who would play me and you? Me and you? I'm not in this movie, bro.
If this was a movie, what would who would play Mat Cashman? Anyways, I'm going to ask you later what book he's reading there. And
okay.
For the record, I'm not sure he was reading this book. But he's obviously an extraordinarily smart individual, as the movie portrayed, extremely successful. And again, the stock was up 600%. So if you thought, Matt, and this is where the options of the KGP is going to come in, if you thought that a stock was obscenely overbought, and I'm not saying it is, we are not saying it is, but he made tweets to this effect, that the stock is quite overbought, right? And you want to short the stock. So these are the things that we are telling you. These are the inputs into your mind. You would want to find some combination of Delta and or Vega, right, for your position, other than just shorting the stock, which you didn't want to do for whatever reason. And there's a lot of reasons why you wouldn't want to do that, right? Fixed risk, etc. So we have the Delta here on the left, and we have some Vega exposure here on the right. And these are both relevant for a couple of reasons. Number one, you can see, obviously, when you go and you buy deep out of the money puts, the Delta of those options drops significantly, right? Yep. And an at the money put has a higher Delta, depending on what time we go into. And then the second thing here is the farther out in time you go, the more Vega, generally speaking, you're going to get on your options, right? So do you know what puts he bought, Matt?
I think they're the 50 strike puts in 2020.
2027. I was hoping that you didn't know, and I was going to say that. Tell me which ones you would try to buy. But this is what's interesting to me, right? Because if you buy the deep out of the money put, the longer dated put, the Delta of those things is pretty teeny, right? And if you're looking to get into some Vega, which the Big Short guy, convexity, all that sort of stuff, you would think like, okay, I want to own some Vega here. So the longer date option checks that box. But if you go too far out of the money, then that Vega really deteriorates a lot, right? So do you have any, I mean, you always offer some great clear-headed insights on these two dynamics. So kind of before we talk about his position specifically, if you want to short a stock for some reason, whatever the reasons may be, how do you think about the balancing out of Delta and Vega, and why would you try to maybe wait into one versus the other, or do you try to find like the perfect mix of both? How do you think about that?
Yeah, I think it's an interesting question. The other thing you have to factor into that is like the weighting of Delta and Vega, but also then you have to overlay price on top of it, because that's the next layer. And for some people, the price layer is the only layer that matters. But if you're looking at the Greeks of these options, the Delta versus Vega versus Gamma, all of that stuff matters as well. Whenever I think about this, I always think about obviously what you said, which is as you go further out in time, if you keep the strike the same, as you go further out in time in duration, the options themselves have more Vega, which is, they're just more sensitive to implied vol movement. If you're talking about something where you want immediate response to downside movement, just like you would get from something that where you would have a short stock position, then you probably want something with a lot of Delta. I mean, like, the nice part, what you said at the beginning of describing this is, he didn't want to have a short stock position, or for some reason he decided not to have a short stock position. Those things can get very expensive very quickly, right? You have to carry them. There are all kinds of issues with it.
And it's scary in a stock like this, being short a stock that has just been going up at this rate of change. So the options, the puts give you fixed strike. He put $9 million into this. He tells us this. And so, okay, that's my risk.
Yeah, exactly. So when you're buying the puts, like if you take any put on the board and you're buying it, you instantaneously have defined risk, right? It's like, okay, now I have defined risk. This is like the most I can lose. If this put goes out worthless, it's the most I can lose. And that goes for any put, whether it's in the money, out of the money, at the money, like whatever. If you're buying optionality and that's the only position that you have on, then generally speaking, that's the only amount of money that you can lose. It's defined risk. So whenever you're thinking about Delta and Delta exposure, there's always the issue of price that overlays on top of it. How much are you willing to pay for it? And when you go that far out, right? If you go out to 20, what'd you say that year they were? 2027?
27, yeah.
Okay, so these are 2-year options. These options have 700 days in them. If you go that far out, the Vega portion of the option starts to make it more expensive in price terms, right? It starts to get really expensive, even for those puts that are like way out of the money, those 50 puts that are way downside. I don't know what he paid for them, but they're going to be way more expensive than the puts that are up front that are struck at like the 100 strike. I mean, like as those price distributions level out, the farther back you go, it gives a lot of actual premium to those options, even way down there. And so whenever people are talking to me about this, the thing that I always think is like, just because he bought the 50 puts doesn't mean he's betting necessarily that the stock goes down to 50.
Yes.
Right? Like there's all kinds of things that can be different about what it looks like a year from now than what it looks like right now. And just the price of the underlying is not the only thing on that menu, right? Skew can change, implied vol can change, all kinds of things can change where that put can be worth something different than it is now, and the stock could be in the same place.
Right.
And the other thing I thought about when you told me you wanted to talk about this is like, I'm sure Brent's going to ask me basically like, why would you buy these puts? Why would anybody buy these puts? Right. And my answer to that is like, I can't tell you the number of times that I bought and sold options through the course of market making. Now, Michael Burry's not a market maker. He runs a hedge fund, but that I bought and sold options in my market making career where I either made or lost money on them through reasons that were not the reasons that I bought or sold them for, right? That were like, I don't know, like what happened? Well, the skew went crazy bid and I happened to be long puts. Did I do that on purpose? No, I didn't do that on purpose, but it just so happens that I have this residual position or whatever. I'm not saying that because Michael Burry has a residual position in this. I'm saying a lot of things can change that change the value of those options and the way that the actual volatility surface is structured between now and 2027, right? I mean, like, it's a long time. And so if you're thinking about, balancing Delta versus Vega, there probably is a sweet spot for most people as far as like, okay, I want this kind of, I want this kind of response to an implied vol move, but I only want to buy 2 years worth of duration, right? I don't want to go all the way out. I don't want to go buy a 5-year option, things of that nature. So it's all of that is a balancing act as far as pricing is concerned.
The thing that I think is curious about this, we'll talk about this in a second too, is there is, and I don't know if there's actually a term for this. Maybe I'm exposing some ignorance here, but when you start to talk about the lower bound of zero, and the stock can only go to zero. So when you're buying these 50 strike puts, how much? I mean, the Vega is going to be affected by that at some point because the lower bound is right there, right? It's like almost like it would retard or slow down the movement of that put option when you start to, like if you ever try to take like a $2 put, like the vols don't seem to react this same or normal way, right? And I don't know.
Yeah. Well, and there's a difference between whether or not you're going to get the juice out of the Delta move down there, or whether you're going to get it from the Vega portion of the option. And oftentimes what can happen is when you get into situations where, and I have not looked at the Palantir skew, I have no idea what the skew looks like.
Mm-hmm.
I would imagine that with a stock that's gone from 50 to whatever it's gone to over the last 18 months, the skew is pretty tilted to the calls, I would think, right? I mean,
yeah, and it's very liquid too. Like this is on that point, this is like a top 10 options name now, right? So, so there's a lot of liquidity. There's a lot of traders in here for a variety of different reasons. So I think the skew is fairly stable, I guess is why I bring that up.
Okay.
But to your point, I think that's the most important thing to understand. And it's a good one. Is like, he may not think the stock's worth $50. Maybe he does, but he would probably also be incentivized to dump those options way before it ever gets to 50, right? Because if we get to 50, it's still an S&P 500 company. Like the odds are that it's a Ponzi scheme and goes to zero is, fairly small. Maybe he thinks that, I don't know. But I guess I would think that you would, and this talks about what I was thinking with this. These are 2 tweets I put out, and hopefully you can read these. But on the right is what I went through this, and I was like, this is what I think he could have bought. And we have this options data now. It tells us where the customers are positioned. And the weird thing about it was I went through the list of options. So customer buys, how much open interest was available when I put this up on the 4th. He bought 50,000 contracts or owned in the quarter, right? So I was like, well, if I was him, I would know I'd want convexity. I'd want a longer dated option, right? But I would have thought you would have gone for something in the, as you can see, the strikes of like the $130, $150 area, because as soon as that stock starts to fall, then those options would pick up a little bit faster. You may get a little more deltas as the thing goes down, knowing that he probably still would want convexity being the big short guy. Again, we have no idea what he's thinking. It's just fun to kind of talk about. But so I went through this list and I was like, none of these positions actually exist. So did he buy like a strip or a bunch of different options? And then I was like, doesn't seem like that kind of a person, right? And then on the left was all the contracts I could find with just the highest amount of open interest. And the first one that you find here that had the biggest open interest, interestingly, is the January 50 strike puts, of which there was 24,000 open interest at a buy side open interest at the time I took this screenshot was the 4th. Now he has 50,000, so like none of this totally lined up. But what was interesting to me is there's all these way out of the money puts, and it looks like normally what people were doing with these deep puts were they were short them, is what it looks like from our data that they're sort of short. But it's just funny to me because when I was trying to like, what put would this guy buy, the 50 strike just seemed so far out of the money that you would need a catastrophic event in the stock, and maybe you'd get it. But also, it would have to happen very quickly, right? If it's a slow move down and it grinds down and it bounces and it just sort of like bleeds out, those puts are also not going to perform very well, right? So it's almost like you have to have an event, right, that just like levels the stock and all the rest of them out. And of course, it's always possible.
Yeah, for sure. Do we know for sure that he bought the 50s? Is this like confirmed now?
Here's the other thing, if you remember the movie, he sits around for days, months, and he's playing the drums and he's marking his position down, and he won't get out of these positions, no matter what, because he's so much conviction. Turns out that on the 24th, he sold half of this put position. So he owned them for about 2 months and then just decided to get out of them, or at least a big chunk of them, I should say. It still seems like some of them are held. And it seems like he just kind of got out for even money. So the big short, diamond hands, not in this instance, I would say, which I just thought was interesting. So this is what he wrote on the 12th. This is his official tweet page. And he was making comment about the $912 million of put options is obviously incorrect. That CNBC had noted. And he said here, I bought 50,000 of these for $1.84, these being the 50 strike 2027 puts. So that's how we know for a fact that it was him, because he said it was him. And so this is the payout of the actual options. This is from our new options calculator, and the stock is, trading up here. And as of today, right, if the stock goes under 150, this is without vol moving, then those options start to go a bit in the money. They'd be about $2.84. So, he claims he bought them for $1.84, so he'd be kind of in the money. What's funny is he sold them. Obviously, everyone knows that, and then now the market's gotten a little bit weak, right? And so those options have picked up in value. So he'd be break even-ish. Right. But you can see the P&L doesn't really start to increase in this situation. Again, we don't shift vol in this example. That P&L doesn't really start to pick up until the stock gets really south of 140 and into 120. And that's right now. Right. So, if you put these options in September and you think that the Ponzi scheme is going to unwind, you would generally think, okay, it's going to happen sometime between now and the next year. I think if you can start to get inside of 8 months left in those options, then they're really, they're not very alive, so to speak. But the vega of these options are pretty small, I feel like, and the delta is very tiny at a 3 delta.
Yeah.
So it just doesn't feel like why wouldn't you instead buy half of the 100 strike puts, for example, like half that size? Wouldn't those be a lot more responsive in a scenario like this?
They might be, unless he thinks that the skew is particularly priced really low, right? If you think the skew is crazy low, then you want the thing with as much skewness in it, which are those like little puts, those tiny little puts. The other thing that you need to really think about when you think about this is that when you buy puts like this, oftentimes people are not necessarily thinking about how much vega they have in them now. They might be thinking more about how much vega they might have in them once the stock already drops $150 or whatever. And that, right, like that put has a lot more vega in it as it gets closer to at the money, right? If you maintain the duration, right, and obviously duration is coming out on a minute by minute basis, but let's assume that something happens in the next 6 to 12 months, which is like, a fourth to a half of this options life cycle. That option is going to get and the move is down. That option down to the downside gets a lot more vega to it, and a much larger portion of its value will be centered in its vega component because it starts to get more vega as it gets closer to at the money. And so that's one thing you need to think about as well, right? Like think about when people buy these things and they're very specific about them, and sometimes they just look at them and say like $1.84 is too cheap, and he pays $1.84 for them. The other thing is, if he sold 25,000 of them, he also didn't say anything about the fact he might have bought a put spread that sold half of these out and bought a higher strike, and you're not going to know about that until the next 13F comes out.
Correct.
Right?
Correct. Yep.
So like there's so much conjecture here. I just from a theoretical standpoint, I want people to like really think about all of the different ways that this bet can play out, because it can play out in a lot of different ways based on a lot of different moving parts of the skew and the surface and all kinds of things,
Yeah. My thinking on it was, if I was convinced that this company was going to lose like half of its value or whatever, and I don't know how much he thinks it would lose, would be buy half the size and go at the 100 strike. Because the other problem is, once you get inside of like a year left for these options, like if something doesn't break to, halfway, like in the next 6 months, then those 50 strike options are really starting to hurt. And even if you are correct and you get like a late 2026 crash, they still may not, they may just have no value because they're going to expire so soon and then it's so far out of the money. Whereas if you bought half of the 100 strikes, those could be a lot more reactive. Plus, you're getting a little bit of of delta there, a little bit more delta, I think. And so the bet will hold some value longer, I guess, is sort of the view. But you're still arguably going to get convexity if the stock starts to really, crash. Whereas this is sort of like a lotto ticket on you really need an event, and you need an event, I feel like, in the next couple of months, right? And maybe he thought that was coming in the next few months, and that's sort of why. Clearly half the position was closed out, like you said in the data. So, it's an interesting thought experiment. Nothing else.
I agree. It is an interesting thought experiment. I also want to caution people against, don't just think that these people who are running hedge funds are all, Pinky in the brain, giant brained guys from outer space, right? I mean, they're just people. That's all they are. And they're fallible just like everyone else. And so I think it's one of those, you would be amazed. How about this? You would be amazed at the number of conversations that I have with people who run large hedge funds who know less than you think they know about optionality. Let's just say that, right? And spending $9 million on puts for someone who runs how big was his hedge fund before he took it offline?
Wow, I should have looked that up. I don't remember.
It's a lot. Whatever it is, it's a lot. Think about that as a percentage of his overall AUM. It's not that much, right? A $9 million bet is and that's really, when you run something like this, I think you think about it in those terms. You think about okay, what percentage of my AUM am I spending on this defined outcome bet? And if it's $9 million, he's probably whatever. It's $9 million. He's put on way, way bigger bets than that, I would guess. And so that's what I would caution people against. Don't try to read too much into the tea leaves, because oftentimes these people don't know as much about options as you think they do. So,
and the other hard part is there could be a myriad of other pieces of this that we don't know.
Yes.
Credit default swaps and this and that and the other thing. And this is just a component of a trade that actually has nothing to do with an outright view on buying these puts because the stock's going to go down like, a retail person would. So we obviously don't know, and I'm not trying to say he's foolish or anything else. I have no idea. I just thought it was quite interesting because the puts to me just don't make a ton of sense unless you assume that binary event is coming relatively soon. And even then, I'm like, I think you'd still make a lot more money buying half of the 100 strikes for the leap. The leap in the idea of we need time for this to pay out obviously makes sense. You want time for your thesis to come true.
Yeah.
But you own a 50 strike put on the stock like this, that could take. I mean, you need a lot of movement for that to happen.
Yeah.
So,
let me say one more thing, Brent. Let me say one more thing about this. I think it's interesting to think about it from the other side of this coin, which is if you were to sell that guy 50,000 of these puts, what would be the risk that you would look at your sheets and say, I have an unpluggable hole in my position? Is it the delta risk that you would have? Is it the Vega risk or the gamma risk that you would have? Because I know what my answer is. What's your answer?
I would think the Vega risk.
Agreed.
Yeah. Right.
So, if that's what you're worried about, if you're taking the opposite side and you're hedging it, right? You and I, we each sell 25,000 of those puts and we hedge them delta neutral. So now we're short 25,000 puts and a bunch of stock, not a bunch, but a number of shares of stock.
Mm.
And then what we do is we look at our risk slide and we look out to 2027 and then we look down, 10 standard deviations. And what does our risk slide say? You're short all the Vega, right? You're short all the Vega because those puts on the way down, they tend to blow up. They roll up the skew. They have more skew. They have more vol. They have more, et cetera, et cetera. And so your risk manager is going to say to you, why are you short all this downside Vega in 2027? What is up with that? Right. So oftentimes I think it's a good thought experiment also to think about it on the other side. If I were to sell these puts to this guy and hedge them delta neutral, or this person delta neutral, what would be my risk that I'd be most worried about? And then think about it from that side, right? It can be useful on both sides of that.
It's a good point. And, that's a 75% lower from here. Obviously these stocks move quite a bit. It's up 600% in a year and a half, right? So it is possible. I would feel like the fact that you would need such a substantial move down to get into where those stocks start to be kind of even near the money would give me a little bit more
Agreed.
comfort, maybe, but things have gone to zero, I suppose, faster. So the delta just doesn't seem like it would be a problem. And usually what happens in these events too, it's like you get the event and the vol spikes, and then things get quiet again, and then the second time vol spikes, it's going to be 6 months later or something like that, and they're just not going to be as kind of like reactive, right? So it's interesting. But here you can see he this is the spike where he apparently closed according to our data, and according to this is I believe this is a volume of the strike. So hard to see that first tranche at least made any money, assuming he put them on in Q3 somewhere. So anyways, interesting idea. I hope that was helpful for people. It just gave a couple of different ways to think about this. And hopefully it just made a little more sense around all of the, we can call it false information, right? That was put out there around
I think it's safe to call it clickbait. Can we call it clickbait? It feels kind of like clickbait when they say he's got $900 million worth of puts on.
Yeah, I think so. By the way, segue before we start talking about NVIDIA earnings, because this is what people are so riveted in. I asked ChatGPT based on our YouTube thumbnail, who should play you in our finance movie?
Who should play me?
Yeah, this is what they say. They say Matt Damon, John Hamm, or Kyler Chandler. I can't tell you I know who that is.
Oh my God.
And Damian Lewis. Is that the Billions finance guy? I don't know, but those are some pretty good, legitimate actors.
They are. That's for me or for you?
That's for you. Well, I got an embarrassing set of people that I don't even want to talk about. Mark Ruffalo, who in that show looks like he's about to have a heart attack and die. Oscar Isaac, I don't know who that is. Paul Giamatti, I'm like, wow. He's like 30 years older than me and about 600 pounds more than me. And Jason Sudeikis, I think he's the guy from the soccer show.
No, Jason Sudeikis is the guy who plays what's the HBO show where he's a football coach who goes to England?
Yeah, the soccer guy.
Yeah.
Anyways, I'm never playing this game with anybody ever again.
I do love that. That was such a slick move.
Tomato. Okay, let's talk to what everyone really cares about today. Ted Lasso. Thank you, Scott.
Yeah, Ted Lasso. There you go.
Okay, let's talk about NVIDIA because that's all anyone cares about now.
Okay.
NVIDIA, we have the earnings implied move at 6.6%. That's based on Friday's options. So 6% is a pretty good move. And so, again, you're not allowed to give any investment advice, but the idea here is we just kind of walk through a few trades that are interesting. And just because you say they're interesting doesn't mean that you should do them, nor me. So I want to start off with just looking at the skew and implied vol rank, just the basic stuff here in NVIDIA. And it's been interesting because over the last 10 days, what this trail shows you, it's basically been stuck here in the sort of rightish quadrant. And that tells us that calls are a little bit rich relative to puts, and implied vol is overall actually pretty elevated. In fact, if you look at the IV rank here, it's 50, which, heading into an earnings generally makes sense. So this reads as calls a little bit expensive based on the year of data and implied vol overall. So we can also break this down percent by percentile. So the call skew percentiles, you can see here, Matt, 58%. So calls are richer. This is the 25 delta call versus the at the money for a 30-day, kind of 1 month option. They're a little bit rich. Puts seem a little bit lower than they've been the last year. So that's the starting point. The other thing that I think is interesting at this moment, which could be relevant to our conversation that I want to bring up, is if you look at the S&P term structure, you can see we're pretty elevated here. But the earnings is on the 19th, right? So SPX options don't price that in, but they do price in, obviously, for the 20th. And so you can see there's a pretty good bump in the term structure there. And if we add the forward implied vol calculation, you can see it's really quite elevated. So the S&P 500 as a whole is clearly bracing for this event. And it's rather unusual for single stock earnings to be priced into the market. At least I generally view it that way. I don't know if you have comments on that.
Well, I would say up until the last couple of years, extremely unusual for single stock earnings to be a part of the SPX term structure because of the fact that like the dispersion trade is the way that it is because of that. But as more of the flow has been really centralized into those 7 stocks, right? And particularly this stock that we're talking about, you could make a case for the fact that, as goes NVIDIA, so goes the SPX. I don't love that, but from a mathematical perspective, I don't think it's like I can't make a case wholly against it either. So that's part of the reason why I think you're seeing it that way now, is that the flow is so like centralized in those 7 names that it's a big part of the S&P. Thus, it ends up being a big part of the S&P vol structure as well.
Yeah, and I mean, it's 35% of the S&P is a semi AI related trade at this time, and as we all know, there's a lot of the credit default swaps. Some of these names like Oracle and CoreWeave are surging, and so there's a lot riding on just the narrative, I think, at the moment, as well as some of the linked flow. You mentioned some of the correlation or dispersion trades that are out there, and you see those in big NVIDIA Tesla options trades on a daily basis versus S&P. It's quite fascinating to watch, actually. Yeah. So this is the term structure for NVIDIA, typical backwardation into an earnings event. We also include forward implied vol because I generally look at that as like the sort of target where we think vol will go after the earnings event, assuming there's not some sort of just multi-standard deviation miss, or you would think that we would see some contraction here in the implied vol. So this all looks pretty normal. Implied vol looks fairly normal for an earnings. It doesn't seem like NVIDIA itself is all that strangely or uniquely priced. I believe last earnings was somewhere a little bit more around a 5% implied move. So 6% implied moves a little richer. Now, when you're looking at an earnings trade, for example, there's a lot of sort of strike expiration selection is always an interesting one. I tend to like to go to not the current expiration, meaning this Friday's expiration. I usually like to go to the second one. And the reason I like that is because you still get some of that elevated vol, but I feel like you get a little more room for the thesis to work out. I also think that a lot of times, yes, the vol is very elevated in these short-term options, but they're like teeny, they'll be worth, 10 cents. Yeah, the implied vol is 100, but it's a 10-cent option, right?
Right.
So I like to kind of go to that next expiration, how I tend to look at it. Just as a sort of a base case, if you're thinking about, hey, I just want to play implied vol correction in something like this or contraction, how do you think about what expiration to go with and the best way to target just vol contraction?
Yeah, well, I mean, if you really want vol contraction, you have to have a option that has a little bit of vol in it, right? I mean, like that's the number one thing. And that means that you're going to have to add a little bit of duration to it. Just like what you said is add some duration. That's just not the option that's just based on the move, right? I mean, like the option that's expiring on the day of the actual earnings is just move, right? It's just binary. And then as you go further out, you start to get less of the binary part of that and more of the volatility part, the implied volatility part of that. And so you're going to get more of the vol movement up and down. I think it is interesting when you talk about those options up front that are like 150 vol, but they're only a dime. It's really important that people make that distinction in their minds when they start to think about it, right? Don't get fooled by just these like massive vol numbers, because guess what? When you have an option that's expiring like the day of earnings and it's trading a nickel and then it trades a dime all of a sudden, the difference between a nickel and a dime is usually like 60 vol points, right? Like you have to, the only way to make that option that's way out of the money worth anything at all is to pump a bunch of implied vol into it. And that doesn't necessarily mean that, when implied vol gets crushed, if it does get crushed, that option is going to get smoked. It just means that it's worth a dime and it might be worth zero. Yeah. So think about it in terms of like how much of this option is there to come out when the vol theoretically comes in, right? And if you're selling options that are worth a dime, how much are you going to make? You're only going to be able to make a dime on them, right? Like that's the thing that you need to think about in that way. But I kind of agree with you when I start to think about, and when I traded these things, this is kind of always how I thought about it, is I needed something if I wanted vol movement that actually had implied vol in it, that had
Mhm.
some amount of vega. Now it's funny because we're talking about the difference between 5-day options and 10-day options and 15-day options. And when we're talking about vega and the difference between those options relative to like the Michael Burry puts and Palantir we were just talking about that have 300 days in it or 700 days in them, right? Like the amount of vega difference between those is like, it's so small. It's crazy,
Yeah.
but it matters now because of the fact that you might be talking about an option that's worth a dime versus an option that's worth a buck, right? And that's a massive difference when you're talking about extrinsic premium to come out of them, after when all of those unknown events become known factors and you get less vol pumped into those options. So I agree with you. I think you have to think about the mixture of the binariness of the move of that option and the implied vol, like sensitivity that comes with a little bit more vega and a little bit more duration to be able to, like you said, to have the thesis play out. It's something you need to think about.
Yeah.
And that's why you'll see a lot of those. That's also why you see those term structures move the way that they do, right? Like those 0-day options are the ones that are super upfront, drag the other options up and down because people are pricing those time spreads back and forth the entire time when those options are trading.
And I know you don't spend as much time watching the vol surface as you did a couple years ago, but
Yep.
the near term options now, because we have so many expirations, I think that hedges out a lot more of the event risk. And so my general belief is that the longer dated expirations, even 30 days and beyond, now stays more stable, arguably, than it used to, due to the fact that you can hedge out NVIDIA earnings with the next 3 expirations over the next month. And so you're going to see more stability for the 6-month out option or something. So what's funny about, I want to play the longer dated option, which is next week's, where it's like the reality of the longer dated is the Michael Burry. So, like this is the Jan. So this is 2 months expiration.
Okay.
NVIDIA options. And this is, the cone is 90 days. And we can put this on a delta basis or a strike basis. So we'll just go percent money. So we'll go in the middle of that. And so, you can see like, okay, the vol is a little bit elevated. And what's also a funny thing in this day and age too, is like people want to get a 10x return on their options now when they trade. And that's so flashy. Whereas the idea of like, I'm going to structure a trade to try to collect 2 or 3 vol points and make, 5 or 10% on this trade. It's just something that, you don't hear of people doing much.
Yeah.
If you're doing the NVIDIA earnings for the January options around here, I mean, I guess that would be the potential here. If that cone is the 90-day range for, for the vols on that, there's a little bit of elevated vol for that, for those Jan options, right? But it's not huge.
Yeah. What this, I think, tells me, the cone is the gray part.
Correct.
Yeah. And so that's the kind of historical range of that skew for the last 90 days.
Last rolling 90 days. So, recent dramas included.
Right. So I think that what this tells you is if you look at the call skew, right, it looks like the meaty puts, right? The meaty puts, the big puts are kind of like, they're at the top of the range, right? The calls are beyond the top of the range.
Yep.
And that goes for like big calls all the way out to small calls, right? It looks like all the calls are at the tippy top of that range. And so if I were looking at this from just a relative value perspective, I would probably be looking at this and saying like, I mean, if I want to trade something that I think that this thing should revert to historical norms, you would think you would be wanting to be selling calls and buying puts in that situation, right? Some sort of analog of those things. Now there's lots of ways to sell calls and buy puts, right? I mean, like there's so many ways to do it. You can even do it synthetically by like, selling calls and buying puts. You can trade with like kind of like at the money downside put 1x2s. That's kind of similar to selling calls and buying puts because it'll react the same way that the skew would react when it moves like that, right? Like buying, it's always one of those things where it's like, if I want to trade the skew, do I have to trade both sides of the skew? Do I have to trade the out of the money calls and the out of the money puts? Or is one side of it more primed for movement than the other side of it? That was something we always had to look at when we were, especially when we were thinking about relative value trades, because relative value is all about trying to buy the cheapest thing you see relative to the other stuff. And so sometimes you would have to make decisions about, like, do we want to trade the whole risk reversal, or should we just buy the put side and then sell some other puts against it, right? Or something like that.
Right.
And so if you're looking at historical norms and this data is correct, which I'm assuming it is, that's the way that I would interpret this, right? Which is like the calls are pretty high relative to historical norms and the puts are like less high. They're still high. They're just less high than the calls.
I like that. We talk about, I try to call it, which feature are you trying to sort of exploit? And,
Yes.
And, the puts here don't seem, there is the event vol thing, but the other thing I was like wanted to ask you about, which I think is interesting here, is there's an idiosyncratic name, like I don't know, I'm looking at Target says our earnings aren't very good, and it's like market doesn't care. Generally speaking, Target may be down 20% or up 20% or whatever.
Right.
It's not a system. It's not a systemic event, right?
Yep.
But you have, and I would call this beta risk or correlation risk. You probably have a more eloquent term for it, or relevant term for it. But if NVIDIA misses in this case, which I think it's our divine right that NVIDIA never misses, but if it does miss in this case, then to the point of the AI narrative and all this other sort of stuff. Now, like, do you ever consider that, or did you ever consider that when you're like making these markets? Like, look, the vol in NVIDIA, the puts seem not terribly expensive. If they miss, then the chance that the beta risk in this name, because it's number one or number two in the S&P, number one and number two in the NASDAQ, that we have kind of like a Armageddon potential across the market, right? In this scenario, makes me less apt to want to sort of be like, I might just kind of leave that alone.
Yeah, well, I mean, the thing that we talked about at the beginning when you said that the earnings are priced into the SPX term structure, the NVIDIA earnings are showing up in the term structure of the S&P, I think speaks to that idea, which is there are reflexive parts of this that, or recursive in some ways, that like as NVIDIA goes, so does the S&P. You could get, right, people who are thinking about this deeply are thinking about those correlations as well. Right. Yeah. They're thinking about, like, if NVIDIA misses, what does that mean for NVIDIA? What does that then mean for the broader market? And do those two things together, are they like Voltron-esque, where like they are more than the sum of their parts to the downside, especially right now, instead of, like what you said, which is Target misses and everyone's like, oh, that's too bad. It happened right before Christmas and blah, blah, blah. And the stock's down 20% and no one really bats an eye.
Yeah.
I think, yes, if NVIDIA misses or misses big, it's going to be a much bigger event than if Target misses before Christmas, right? Like it's, there's so much built in.
This is over if NVIDIA misses. You probably want to sell Target if NVIDIA misses.
You probably want to sell everything.
Yeah. And this is SMH for the same Jan options, right? And the implication here is that the calls are not quite as rich and the puts are actually interesting, like those 80% moneyness puts. It's a pretty small put. That's a 10 delta put at the moment, but that seems significantly cheaper on this relative basis of this, this one data point. So the other one here that we talk about, and I think I have explicitly talked about this before, is trading another name that can express the NVIDIA outcome, because the NVIDIA are pretty cheap. So like in this case, with the S&P pricing this in, if NVIDIA is good, well, NVIDIA is, I don't know what it is, 40% of the SMH. I just kind of
right.
SMH is going to go up or down based on those NVIDIA earnings, and the implied vol contraction is going to be smaller than NVIDIA itself. So what I wanted to kind of get into with the calculator was the idea is you could be right, because NVIDIA is, particularly upside, I think this is a bigger concern. If NVIDIA beats and goes up, but the calls still lose a bunch of money, right? And you don't want to, obviously that's not great, even though the whole market could really start to move up here. You have SMH or the Qs, maybe a cleaner way to play that upside out of that earnings event because of the vol contraction that almost certainly comes.
Yeah. I mean, I think when you look at it that way, you have to think about the NVIDIA skew is the way that it is because of the flow that has been pumped into it in different ways. Does that flow exist in all of those other names? Probably to some extent, but I would guess in a much, more muted way. And so you're going to have more muted price discrepancies between the calls and the puts in there as well. You're probably also going to have a much more muted um, elevation of vol in many of those names as well. And so we would do that kind of stuff all the time where we would go say like, well, and we were doing it on the interest rate side most of the time. And so in the German bonds, right, if the 2-year and the 5-year are crazy expensive to the upside, what is there in the 10-year, right? The shots in the bobble, what's there in the Bunds, right? And we would do those kinds of things that are plays. Obviously, those are on the duration curve as far as the rate term structure. They have all kinds of other idiosyncratic things in them. But when you're dealing with something like this, that inevitably before an earnings date and something that is widely held as NVIDIA, there's going to be a lot of kind of like interest built into like just, pumping options up full of value, right?
Yeah.
And you may not see that quite as starkly in the other names, and that can certainly be a different place to look for things like that, especially in other names that are correlated highly with NVIDIA.
Yeah, that makes sense. So this is one of the things that I honestly have a little bit of trouble with sometimes is you know that vol is going to contract, right? So you put on a call spread, and I'm just picking some random options in here, but let's just say we get long 25 delta calls, and then I know that the vol contraction is going to happen, right? 90+% chance that vol contracts because of earnings, right? And I don't want to pay that fee, right? I want to pay that cost of the vol contraction. So what I would normally go, okay, let me sell another call. And then in this case, what you're doing then is you're just selling, you're buying a call, but you're buying an expensive call, right? So to your point before about relative value, if I put the call spread on, I am just going to go ahead and buy what is arguably the most expensive option that's out there, right? Even though it's smaller in terms of premium price, I'm still just buying that expensive option. And it's like, well, how do you sort of work your way around that? You could buy the SMH calls if you want to, or a call spread maybe, and then pay a little bit less, vol there. But is there a better way to sort of structure that? Like, let's just say I have a long view, or I want to play long with NVIDIA out of these earnings. What is the right way to think about?
Long underlying, long the stock view?
Like NVIDIA. I think NVIDIA is going to go up after the earnings report. I think it's going to be good. I think there's going to be a short cover. I'm not saying that, that you should actually do this. I'm just saying for the sake of the argument, this is the position I want to have. I don't want to buy the stock in case it misses. So yeah, I want to buy something like, I don't know, 2, 3, 1 month calls, 2, 3 weeks, 1 month calls. How do you think about that? Because here we can pull the implied vol down. I don't want to pull it down that much, just to illustrate this point, right? So let's say they beat, right? Vol comes in, and then we can flatten the skew out a little bit here.
Look at that.
Yeah, look at that, fancy, right? All right, so we flatten the skew out, and now this gives us two different P&Ls, right? So the purple line is the P&L off of that implied vol adjustment. And in this case, this is a short call spread, right? So I actually need to flip this for the sake of the argument. So we're selling the call spread here because in the conversation before, we thought the calls were a little bit rich, for example, right? Okay. But the problem with shorting the calls in that example is I'm buying the expensive call, right? I'm buying the 230 strike, which has a higher implied vol and is probably the most affected option by the implied vol contraction, right? Agreed. So is there a way around that if I don't want the naked risk to NVIDIA upside here? And you can see how the P&L changes. The dashed line is off of current market vols, and then the purple line is off of the adjusted if vol contracts and skew changes. And the reason that's interesting is because you own this option, right? The 230 strike option as part of your call spread. And, that's the one that's getting pummeled. That's really, hurting your implied vol. And this is just 2-3 days after expiration, right? So this is after the earnings event, right? So, that's a material effect to the P&L. And so it's like, can I short that skew, that call skew, without having to buy the most expensive options?
Yes and no. I feel like we inevitably end up here every time we have a discussion, but what about call flies? What about the idea of um so the thing I always loved about flies is that they were defined outcomes, right? Your flat units essentially. When and sometimes what people do is they look at a certain area where they're like, I these are really expensive, right? If you think these things right here are really expensive and you want to be short these, but you can't be short them naked, figure out a way to be short them while having other long options in other places where you think they might be less expensive, right?
Mhm.
Like, and so sometimes when people want to do that and they don't want to buy the really expensive calls, they do like broken call wings
Mhm.
flies, right? Where you are buying the at and selling the 25 delta call that you think is crazy expensive, and then you're adding a little bit of distance between that strike and the further up strike that has it might be more skewed from an implied vol perspective, but it's just less premium, right? It's
Mhm.
just like an option, like what we were saying before. When you're talking about like selling dime options that are 175 vol, you
Yeah.
can call it 175 vol all you want, or you can just say it's a dime and that's how much I'm going to make. Well, the same goes true for the options that you're buying. If you're going to put them on the upside of a call wing, right? Is like, if they're only worth 40 cents, like that's the most those things are going to come in as 40 cents. So, um, that those kinds of trades can be interesting also when people are looking at very specific parts of the skew and they have a directional bias, because like owning a call fly like that gives you and can give you, especially if you buy it and don't hedge it delta neutral, can give you directional bias in a defined outcome way. Now keep in mind, anytime that you change and don't have a perfectly identical distance between the strikes of a call fly, you're incurring a little bit more risk on
Yeah.
wherever the wider side is. Yeah, exactly. And so it's not perfectly symmetrical from a risk perspective anymore. So anytime you do that, you need to keep that in mind. But aside from that, that can be something that people utilize in situations like that where they feel like the whole call wing is expensive, they want to be short it, and they feel like they have an upside bias, but they don't want to be net short units, right? Or short a bunch of premium.
Yep. That makes sense. So in this situation, then, if you're setting this up and you're looking at this, is the basis point to start this off always delta neutral, or are traders not necessarily think about that? So, like, I think a lot of times to fly, it's like at least make this 1x2 delta neutral. I tend to not look at it like that, but is that the kind of best rule of thumb?
I mean, a lot of people like to look at just, yeah, what this looks like from a delta perspective. If you're looking at the delta of the overall trade, right, the cumulative delta of the whole thing, it's just going to give you an idea of how that's going to react into massive movement. And it's really just, especially, listen, when you're talking about situations like this where there's a lot of vol built into it, right? When the vol moves, the delta of these options, every option on the board is going to change, right? And so you need to be thinking about like, okay, what does this look like when vol comes down 20% or 30%
Mhm.
or whatever? Look at the delta of what it is after the move theoretically, and start thinking about like, what does this look like after the move? Because it's going to be different than it is
Yeah.
right now, right? As you
Yeah.
move vol, like if that whole vol curve comes down, all of those deltas move, every single one of them.
And I like that idea because sometimes you set up a trade where you're trying where I'm thinking about trying to get a free option for, like, so in this case for January, right? Like, can I play short term and implied vol correction, and I'll be somewhere like a diagonal where I'll sell some sort of short term option like the 220s and then buy like the 240 in January or something like that,
Yeah,
because
yeah.
I want that free optionality. So, like, can I offset that cost now, because that implied vol will contract, and then I will possibly have like what will turn into some deltas if the stock does the move that I think it will do.
Sure. You have to keep in mind when you're doing things like that, that you are trading a time spread. Don't ever forget that you're trading a time spread,
Yes.
right?
And then there's a lot of path dependency to that too. Like, if the stock could rip, I get buried, and then so it
Yeah.
doesn't. there's obviously risk in doing that, but
yeah, of course.
that is overall very helpful. I know we're coming up on the top of the hour, and I want to be very respectful of your time. You've already been great dealing with my Michael Burry thing as well. I wanted to ask you one quick question, and feel free to throw the tomato at this one, but there was a bunch of bank notes out recently about the zero DT stuff and the daily condors and things like that. And the thing I wanted to ask you about this is that you're familiar, obviously, with the daily condor that's been coming out. It tends to be, and I'm looking at zero DTE here in our trace tool. And so you'll see here is one of them. It's a small one, it looks like, but the point of the topic will be the same. The white line is the S&P 500, and then the purple line here is the deltas, right? So people are pounding the options today in terms of buying puts, and so if you have on a zero DT option as a market maker, right, or as a dealer, or whatever your position is, and this is a $5 wide put spread. So, this isn't particularly big. Looks like there's a couple of spreads here. But the gamma of that spread is not very high, right? Because it's a $5 wide spread. That's it. At most, maybe sometimes they're $10 wide. So there's not a lot of gamma necessarily with that, but there is a lot of, I call it strike risk, I guess, is the way that I have been referring to it, where the gamma of your portfolio is not moved by this much, but these options are going to expire in the next 1, 2, 3 hours. So the strike risk is high there, because whether or not we close on one side of it or the other of these strikes, there's millions of dollars of P&L swinging around, right?
Yes.
So how do you, first I would say a lot of desks now have a zero DT, dealer desk or market maker desk, and then all their expiration flow, from how I understand it. But how do you break that risk down versus like what's being hedged here is arguably not the gamma of the position as opposed to, the P&L itself? I don't know the right terminology to describe that. Totally wrong. It is the gamma that's being hedged.
No. When I look at something like this, I look at it in terms of like if those puts are right next to each other and there's $5 in between them, and I have 10,000 put spreads on that are expiring today, and they're below where the market is trading. Generally speaking, though, that thing, right, matters as a function of strike risk, which you said, and then how much premium is in that thing, right? So like, what's in the put spread? If the put spread's worth like, $1.50 and it's a $5 wide put spread, that's a lot of premium built into something like that. And I'm thinking about it in terms of like, okay, that thing's worth $1.50 and it's got some amount of delta or some amount of something built into it that is going to also have me carrying futures in some way, shape, or form against it, right? It's got some delta, it's got something, it's juicy. And then as time goes by and we get closer and closer to expiration, if that thing has not come into play, it's going to obviously decay at a rate in some way that's going to make it worth less and less and less as time goes on. And what that ends up being is like, now as you get closer to expiration, it becomes far less modelable, right? And it just becomes risk. It just becomes strike risk from what you said, right? If the thing's only worth a dime or 15 cents, that's just straight risk, right? And you're short it, or even if you're long it, like whatever. If you're long it, chances are, and you've got a bunch of them on your sheets, chances are you've done what option market makers will say, taken it out of your position, which means you've pulled it out of your position far enough that it has no delta and you're not carrying any SPOOs or any underlying against it. And in that case, what you have is just like what we would call a free put spread, right? That's just sitting down there. You're long it. If it goes through the strike, it's just like, okay, free money. Like, congrats, everyone, high fives, and like, drinks are on me. But if you're short it and it's trading a dime, right? That's just risk. That's just strike risk, because it's, regardless of whether you're long it or you're short it, it is unmodelable, right? With like 15 minutes left in the day, it's unmodelable. It's just binary risk. And so that's how I would think about it as a market maker, and how I used to think about it as a market maker. I used to think about it in much more kind of like real risk terms, instead of, and try to kind of like use some of that to to inform your idea of what your delta, gamma, and theta, et cetera, look like on your screen in front of you in aggregate. Like how much of those numbers is coming from that thing down there that is kind of unmodelable? Because that thing, if it's a big part of your position, is going to drive a lot of those headline numbers that aren't necessarily real, right?
Yeah.
Like that's what I'm trying to get across is that Greeks can sometimes lie to you when you try to model something that is unmodelable, right? It's like, so that's
Especially,
kind of how I think about it.
what's especially relevant when these positions come on at 10:30 and they're gone by 4, or they're rapidly adjusted throughout the day, where it's kind of like it's a challenge, I think, to model them, to your point. But what is odd about it is, and this map is representing gamma, is what's odd about it is you start to look at the positions. This came out from UBS, and they're modeling these positions that come in on a daily basis. And the argument is that the S&P does seem to be reacting, and I make the case that the S&P does sort of react to this because there is some flow that is trading against these things.
Yeah.
But I think gamma represents it because gamma is highest for at the money options and blah blah blah. But it's not necessarily it's not gamma risk that's necessarily being hedged or traded. It's it's something different.
Yeah. Well, and in many ways, I heard someone say the other day essentially that like as we get more and more of this flow that is centered in these very short-term options, what ends up happening is that the charm aspect of it, right? The delta decay of those positions actually becomes more and more a part of the how the complex trades and how it like. And I'm not just saying how the complex trades. I'm talking about like how the complex moves, like how the underlying moves, right? If you've got a lot of very rapidly decaying options that market makers are holding, and if they're long calls and they're short futures against it, and those calls are the value of the calls is coming out rapidly, right? The futures that they're short against it are not coming off at the same time that the deltas are coming off on the calls. And so they have deltas to buy in whatever way they do that, right? They could go buy futures, they could sell puts, they could do all kinds of things, but they need to make some offsetting long delta trade to stay delta neutral. And cumulatively, that starts to express itself in different ways, but oftentimes people will see it in the way that the underlying is moving. And that's, as the volume starts to shift into those options even more, I think that becomes even more a part of the landscape and the way that the risk kind of transmutes throughout the whole thing.
Yeah, that's interesting because I would just add, and again, I'm now taking like way too much of your time, so I apologize. But I would also add what's interesting to me about this, two things. Number one is from just a position perspective, they own the dealer side owns these spreads, right? So you would think they would be incentivized to move the market through these spreads in some fashion, which doesn't seem to happen. So it suggests they're making their money off the hedging of it or offsetting positions, right? That they're monetizing somehow. But then the other one is interesting is everybody knows the trade is coming, and because it comes at the same time every day, and it now comes in every single day. And it's like, how is this not blown up against the parties putting the trade on? It's like never in the history has a trade just continued to come on every single day, and that person not being adversely selected against that, like at some point, you know what I'm saying?
Eventually, yeah, for sure. I will say this though, I have never lost more money than having a expiring downside put spread that I am long futures against, and the market has gone right down to my long strike, right? That is the absolute worst thing that can possibly happen, because what happens, all the futures that you're long, you lose on, and then you never go through the long strike. You never get to like that put spread never comes to fruition. And if you had it marked at $1.50 yesterday, you're losing all the money on the futures, and you're losing the $1.50 that the put spread was worth because it never came into the money. And that, those can be very painful trades. Yeah, max pain, exactly. And when you say like, I would think they would want it to go through the strike, they want it to go through the strike, but they want it to go through the strike at like 9 a.m., not at like, 2 o'clock in the afternoon after they've lost all the money throughout the day, all the way down to the strike, and the thing's worth zero. It becomes a very touchy kind of like a dance to do. So it's not easy,
It's fascinating. There's obviously a lot of different parties in here playing around
Yeah,
too, so hard to suss
for
it
sure.
out. Well, Matt, I stole an extra 10 minutes of your time here. Thank you so much for joining us. I learned a lot, as I always do. We talked on the call flies again. I don't think I triggered any compliance department problems.
Tomato.
So I'm happy about that. I hope everyone enjoyed the conversation with Michael Burry and also the NVIDIA trade ideas. So thank you very much. If people want to get in touch with you, you're doing so many webinars now. It's amazing, and a lot of that is on LinkedIn, right? If people want to find out those
Yeah. Most of the stuff you can find on LinkedIn. I'm also on Twitter, but I'm not as active on there on FinTwit. But you can find me on LinkedIn at Mat Cashman on LinkedIn, and check out the all of the educational stuff we have at optionseducation.org, which is the OIC's webpage where we host all of our options education.
Yeah, the education get a lot better. It used to just be like a little P&L graph, and I think a lot of this attributed to you. So kudos to you for that.
All right, right on.
Over here. So
happy to help.
Thanks so much. Enjoy the rest of your afternoon.
Yeah. See ya.
All right. All right, everybody. We're going to hold on here for a few minutes. I don't want to bore Mat Cashman with my market talk. Normally, we would just end these conversations as soon as they're over. I'm going to stream a little bit extra here, just talking because I saw some people with the market kind of falling apart here. Just want to do a quick health sanity check of the market itself. A couple of things here. Obviously, I've not been able to keep in tune too much with the way that things have gone over the last hour. But I wanted to look at, number one, the deltas that's going on. Now, if you're a SpotGamma subscriber, you know that one of the things that's most important to me that I check all the time is what is the complexion or the tenor breakdown of what is happening on the day. And so in this case, we're looking at hero for the S&P 500. The purple line is the flow from all expiration. The teal line is just from zero DTE. And when I look at this is a lot of zero DTE flow. In fact, 8.1 billion of the total 8 billion is zero DTE, right? So when I look at this, whatever is going on today seems to be zero DTE driven. Now that makes this drawdown a little less nerve-wracking, I would say. If you're short and you're celebrating, that's great. But it's a little less nerve-wracking for those of us that are long. And I'm leaning mildly long as per a founder's note into tomorrow afternoon. I don't really have a whole lot on. So the thing here that's interesting is, again, the fact that it's mainly zero DTE pushing us lower here. The concern would be if this separates, right, and you get space between the line that the purple is crashing lower, that suggests that longer dated puts are being bought, longer dated calls are being sold, and that implies that there's concern about the future in a different way. So this is certainly not a powerful position for the market. It's an ugly position, but the fact that this is zero DTE tells me that I don't want to be sort of all in short at the moment, waiting for this thing to sort of just continue to break down, unless these flows continue to go lower, right? Obviously, if they continue to go lower, that's great for shorts. But if you want to give bulls kind of like one shadow of hope, there, it's that on the single stock side, it's actually positive on the day. So what this is the individual stocks in the S&P 500. It was quite strong in the afternoon. We obviously rolled over. I don't know if there was news since we started this conversation with Matt. But you can see here there was some breaking out here earlier in the day, and that has failed to sort of materialize. But the single stock space is pretty neutral, $150 million positive of deltas. So it's not like people are buying puts and selling calls in size like they were last week in the single stock space. So that's kind of the breakdown. If you go into the founder's notes, that are pivoted at 6,800. It's funny, Goldman now seems to be producing like a risk pivot. There was at 6,725. We're up at 6,800, and the big concern here is that there's no positive gamma really across the entirety of the S&P 500. You can see that purple line here is negative across the board, right? And so what that infers is that there's not this area of positive gamma that can come in and really support the market here. And if that positive gamma is there, it contracts market ranges, vol can come in, and then the short vol trade starts to work. In this case, it's negative across the board. We obviously have, I saw some chat mentions there about Trump talking at 6 o'clock. I don't know what that's quite about. But obviously the NVIDIA earnings coming up is the big thing. And so, what this feels like is the path of least resistance right now is just lower. And these are sizable deltas that are getting dropped on the market. Even if they're zero DT, they're still real. $10 billion worth of deltas is quite large. And so, that is the big concern for the market. Now, the second thing in the dynamic that I talked about, which I actually thought that the market was going to have a little bit of strength today and tomorrow, was the fact that VIX expiration is on Wednesday morning at 9:30 in the morning. Now, the last day that you could trade November VIX options is tomorrow. You cannot trade them on Wednesday morning. So if you want to sell your VIX calls that are making some money, you have to do that today or tomorrow, right? You can't do that Wednesday morning. Now, the VIX index price will still shift around and settles at 9:30. But my argument that I was making this morning, and this looked like a fantastic argument when the S&P was kind of moving up towards highs of the day, right, was that people would be incentivized to monetize those VIX calls. And this is the breakdown of open interest, pure open interest for the VIX expiration. You can see there's a lot of it in November. This is the November expiration that is for Wednesday morning. And then that night we have NVDA reporting. So, these positions have to roll over. And the argument is if these VIX calls are making money, then they'll be sold, and that can reduce some of this hedging pressure that is pervasive in the market. Now, the fact that the S&P is just kind of puking is going to elevate S&P vols, which elevates the VIX index, obviously. So those things are all related. And the result here is we're getting a VIX term structure that is, working its way towards inverting. And if you've studied this, you would know that when the VIX term structure starts to flatten out, that is actually the signal of major risk. It's not when it's kind of arguably too cheap, right? It's the situation where the VIX term structure is sort of flattish like it is now, and that's kind of where, bad things really happen. So, this is not a comfortable position at all. This is certainly quite a risky position, really on both tails. And if you caught the OPEX effect over this weekend, if you go to YouTube and search for OPEX effect, we really talked about this, where the trick is here that puts are now pretty expensive, right? Downside hedges are pretty expensive unless Armageddon happens. If NVIDIA misses, then of course vol is going to go crazy, and then we're going to have a major vol event. So then your puts and your put spreads would pay off, right? But if you're sort of it's sort of like if you're adding puts now, you kind of just miss the move unless you have to hedge something. Now the upside is expensive as well. And so we were talking about how you can, put some call flies on or some call spreads, right, to maybe play some upside in the event that NVIDIA beats and resets the AI story and people love it and we kind of rush back in. And so, the argument there is that call flies would be an interesting way to play that upside. But, I don't want to downplay the risk that's here. I just think we can't really put a fork in this thing until NVIDIA says like yay or nay. And that's also why the OPEX effect was making some jokes about, Jensen and he's our last hope, right? The Obi-Wan Kenobi thing. So, that is the take right now. This is predominantly, just to re-summarize this is predominantly a zero DTE move, I would say. We're getting weaker, certainly in the single stock space. We're still flat right now. Again, it's working lower, as we can see here, right? There's not this buying pressure that's coming in. And then the S&P 500, it's a lot of zero DTEs. We kind of bounce and retrace to 6,700. We've already had a bunch of like false moves. But at the moment, if you are going to take a stab at something, it seems like a tactical long at best. And quite frankly, as long as these deltas keep kind of rolling over, meaning the hero signal keeps rolling over, it's hard to say, let's get involved the long side at all because of the fact that there's just not a lot of strength whatsoever. And then I saw some other people talking about Bitcoin. Bitcoin as a risk proxy is, I think, based on two things. It's a signal of the liquidity that's available in the market and sort of risk taking. It's out there on the spectrum, and it is getting absolutely clobbered today. So, this is just not something that is also sort of, speaks well to risk. And if you ever looked at, the correlation of the S&P and Bitcoin, they seem to kind of have an echo, right? With Bitcoin maybe moving a little bit faster, a little bit first. So there is just at the moment, not a lot of reasons to want to stick your neck out here, but these are short-term deltas. And so, I think again, you want to just take that into account. And until NVIDIA sort of sings its song, I don't know that any of these moves can be counted on as trends. So that's where we're at the moment. If you're looking for downside risk, the other thing we covered in the OPEX effect is you're looking generally for this area where the negative gamma to the downside sort of lapses or moves away. The positions now have changed that it seems to be the 63.25. There's a very large put that's there in the gamma space, and under there positions really start to wane. But you can see that there's a couple of big strikes in here, but the GEX or the negative gamma seems to really subside at this moment under that level. So you would start to think about, okay, we're going to talk about worst downside scenario. It's that kind of idea. But the tricky part here, particularly as you sort of look across this, is you just say, okay, it's ugly now. Yes, but who knows what Trump announces at 6 o'clock? This thing could easily go back in your face. And then if NVIDIA misses, then you get the AI, the full collapse of the AI story. It's like that's a sell-off you can kind of count on, right? Whereas the trick here is that it feels like, okay, I can catch the trend, the day trade lower, but that all could easily reverse pretty quickly. So it's a very, it's a tenuous spot here for, I think, expressing either a long or short view. And again, with the vols expensive, it's also hard to really think that puts are all that attractive, at this moment, given those elevated vols. So, that is the situation. Again, it's certainly a tricky one, and I think all these moves are very transient, meaning they could roll over pretty quickly. And so, I think in these moments, a lot of times you're just like, look, the best thing is to not necessarily do anything, right, and to think about what the big catalysts are coming up. So. Probably not the thing you'd hear. You'd love to hear, like, Brent, tell me exactly what to do. And I think in this case, it's sort of like, let's wait for the smoke to clear. There's a lot of smoke. There's a lot of noise. And there's also a lot of negative deltas, as you can see here in Trace. So for those of you who are day trading, you want to watch Hero. If Hero continues to be negative, trending negative, then there's no reason to get off the short bus. It definitely has that appearance, right? This doesn't look like it necessarily wants to turn around. Same thing on the S&P side. It's just been trending down all day. And again, as long as that continues to be the pervasive direction, I don't necessarily want to fight it. So that's it for me here. We'll obviously back tomorrow, I believe, with a lot more. Yeah, unknowns unknown, Michael, right? And that's the scary part here is the sort of known unknowns. We know AI could very easily blow up and these credit default swaps go crazy if NVIDIA, ruins the story, right? So, that's the kind of tricky part. And until then, like, what does Trump announce? I don't know. He could announce more checks for everybody or something. It's like, it's just a weird, it's a weird spot. And, if you get that negative NVIDIA earnings outcome, like, you can position for that, but do we rally first to 6,800 or drop to 6,500 before then, right? And then you say, okay, well, what would I do from that point, right? My trade would be totally different depending on what price we go into the NVIDIA earnings event, which is why we didn't really discuss any NVIDIA-related trades today, right? Because we need to, it's the path dependency of where the market is at right now, or where it's going to be going into the event itself, plus mixing in, which is maybe a more important VIX expiration impact now because the VIX is, trending higher. So a couple of different dynamics there make it a little bit tricky to sort of navigate at this moment. So we're going to wait for it to clear up. Again, as long as Hero is trending lower, though, hard to make any case that this market rallies. If Hero starts to turn up, if you see these zero DTEs start to turn up, then you can have a pretty sharp, rally back to the upside. So if you're day trading, you just watch that data. Obviously, I can't predict which way the deltas will trade, but that's what you want to watch for the intraday signal as we march forward here. And there's a lot of open interest in this general area in the 6,700s, right? So, there is good, you can make a good argument for a short-term bounce here because there's a lot of zero DTE positions as I click back and forth. There's a lot of open interest up in here. So if you get a little turn up or a pause in these negative deltas, then you could easily have a rally back to 6,700. So, that is that again makes it tricky. It's just as tricky to sit here short, even though you're probably up a little bit today, because there's plenty of fuel and negative gamma to the upside for this thing to rally. So a lot of times, you can make the case that we're leaning one way or the other, and that right now seems like a real two-sided argument here for even what could happen just the next hour, much less the next day. So those are the dynamics. Watch for any type of vol crush tomorrow that could really push us back. And then on Wednesday morning, we're going to be coming back with a bunch of trades into the NVIDIA earnings event. Both talking about ways to trade NVIDIA, but then also ways to trade S&P. So those will be some of the things to watch. So we will, no federal tax, and then comes up to 100K. That'll be interesting, right? Who knows? So anyways, I love y'all watching me saying, not sure, tread lightly here, but that quite frankly is just, that's just got the look that we have right now, right? If we were seeing pure longer dated deltas coming into this thing and vol spiking, then you just be like, okay, why even think we could bounce here, right? But again, it seems like a real 0DT driven mess. So, all right, stay light out there. Hope everyone's having success trading. We'll be back for sure tomorrow and on Wednesday with a lot more kind of actionable content, I would say, as we move out of this. And I hope that you found the Michael Burry and NVIDIA conversation interesting. If you have any questions, info@spotgamma.com is how you can get a hold of us. And again, we will see you all tomorrow.